When we look at the commodities, first of all, just take a step back and look at the cycles in commodities. So we had a big secular bull market in commodities from 2000 to 2007-8, and that was driven by this big pickup in Chinese investment spending. So that ended in 2007, 2008, and so commodities have gone through a massive washout. So we got to a point early in this year that again we've gone from the calls for peak oil in 2008 when oil was going to go to $300-400 down to when oil was going to go down to zero this year. So as you can see, the sentiment went to extreme. So when we look at global growth broadening, when you see Chinese stabilizing, commodity prices actually look good. Oil looks okay. I mean, it's had a big bounce already, but if it falls, that's a great buying opportunity. Copper, precious metals, again, precious metals are good diversified in the portfolio, a hedge against inflation. So when we look at putting a portfolio together, expectations play a big part. So for example, if inflation expectations are so low here, inflation falling a little bit more, it won't be a surprise. Won't be a surprise if inflation goes the other way. That will surprise a lot of people. And so precious metals here will be a great diversifier. So there's a lot of opportunities, but again, it won't be a one tide lifting all the boats, which we had a secular bull market previously in commodity prices. It's going to be a lot more selective, and that will be on a rotation basis. So you just go and pick those commodities, and then when you just look at sentiment, when the sentiment is depressed, you buy it, and when sentiment is over optimistic, you sell it. But overall, it's commodities market is becoming more of a trading market as opposed to buy and hold market.